Good morning, folks. This is Nick Randall with Western Marketing. I want to thank everybody for taking time out of their schedules today. We're going to be going over Guaranty Income Life. They are, longstanding player with Western Marketing. We've been doing business with these guys for a long time. Love our relationship with them. Got some pretty unique products, which I don't want to steal too much of Joe's thunder, but we've also got Joe Schaefer. He's the internal wholesaler with Guaranty Income Life, and I'll kind of break down the different products, a new product offering as well, or maybe a revision of an existing product, more or less. But certainly, I think Guaranty Income Life has its place in the market. They are a growing carrier, a rapidly growing carrier, and I think they warrant a lot of attention from kind of some of their niche products, and from a business standpoint. They are very easy to work with, so I certainly think that anybody who's working with Guaranty Income Life could probably say the exact same thing. They're a very client and agent-friendly company. With this, this is going to be a recorded webinar, so a couple of housekeeping items just for folks to know. If you have questions, you can type those into the questions panel, and then we will address those questions at the end. Like I said, it is being recorded, so if you're hopping in, you have to hop off early or jumping in late, that's absolutely fine. I'll be sending the recorded version for all folks who are registered, as well as an email that's going to kind of go over what we're going to talk about here today, and as well as how to contract. It does all go through our Assurance Bay, our online contracting platform, so you can use that for Guaranty Income Life and obviously several other carriers here at Western Marketing. But with that, I'm going to hand things over to Joe to get things started.
Awesome. Thanks, Nick. Appreciate it. And appreciate everybody taking time out of your busy schedules to jump on the call, learn a little bit more about us here at GILICO and our product offerings. So just kind of want to start off, it's really been an exciting year for us here at Guaranty Income. I was kind of talking to Nick earlier, said you kind of feel guilty to say you're having a good 2020 just with everything that's been going on. But from a company standpoint, it really has been an incredible year for us. We're on an incredible growth trajectory here. So I just kind of wanted to go through a little bit of what's been happening with us here. So to finish out last year, so technically on the first of the year here, we actually finished our acquisition of Lincoln Benefit Life's closed block of business. And that was a huge infusion of capital for us here. So we were just under about $2 billion assets under management at GILICO. And then as you can see here, we acquired $16.5 billion in AUM from that LBL transaction. And so that really kind of helps open the door to get us to where we want to get to. Right now, we are a B++ rated carrier. Our goal is to get to where we're an A-rated carrier and to get where we're doing, be somewhere in that kind of top 10 type category as far as total sales here as a company. So this was a big first step for us. Unfortunately, with rating agencies, apparently during pandemics, they're not quick to upgrade. So, we'll continue to be a B++ carrier for a little while here. We manage our block of business as if we're an A-rated carrier so that when that day comes that we finally get that ratings upgrade, we won't see this significant shift in the products that we're putting out there. So internally, we run it like we're an A-rated carrier. We try to, walk, talk, act like we are, and hopefully soon things will happen for us to where we get that. Part of the growth and expansion, we traditionally had been a MYGA shop with this kind of niche long-term care, the AnnuiCare product. In January, we actually expanded out our product offering. We launched our first indexed annuity series called WealthChoice. So we will kind of get into that. It's very competitive, very competitive rates, and a really cool income rider. Really a product that takes a back to basics approach, puts the client first, keeps the story simple for you guys in the field as you're selling it and sharing it with everybody there. Then in April, we'd actually created a MYGA called RateWise back in 2018. We originally just ran it through the bank channels. We just kind of felt like there was a floating rate option that's tied into it, as well as a fixed rate. And we built it thinking it'd do well in the bank channels. As we kind of talked to other IMOs about it, everyone kind of said the same thing, like, I think that's something we could sell outside of the bank channel. So we did actually open that up in April. So know the product that's available for everybody. And then the exciting news for us here in October, our long-standing Guaranty Series, which is the MYGA series that we've offered for quite a while here, is actually going to get replaced. We're launching a new MYGA series called Guaranty Rate Lock, and I'll kind of go over that product as well. So today I just kind of walk through AnnuiCare, the WealthChoice series, and then the Guaranty Rate Lock. So AnnuiCare, I think hopefully most of you on the call have kind of heard about it. The team at Western Marketing does a fantastic job of promoting this product and pushing it out. So hopefully you guys at least heard it or seen it once maybe. We were the first to create this hybrid model for long-term care. So it's a fixed annuity with a long-term care rider attached to it. We created the product back in 1999. So we were first to market in this space. And really what we wanted to do was, create a better way for long-term care coverage. So by creating this hybrid model where it's a fixed annuity with a long-term care rider, clients' money is safe from market risk. They can still access it. They still can take penalty-free withdrawals. They're not losing the value of it if they never need the long-term care. And then the big thing for us is you get 3 times the value of your account balance for long-term care needs. So you put in $100,000. Day one, they have $300,000 that can be paid towards a long-term care event. And again, like I said, if they don't use it, no big deal. Once they're out of the surrender, they can take the money and run if they decide they no longer need long-term care coverage for some reason. When looking at things that this really helps to do compared to traditional long-term care and just, or even just going the, self-funding for long-term care, obviously it's protecting you from high cost of care. This second bullet point, it's maintain control of your assets. But I think even bigger than that, when we're selling long-term care, it's allowing your clients to maintain control of their lifestyle, right? We always talk about retirement, the go, slow go, no-go years. Nobody really likes to talk about the no-go years, right? The end of that retirement cycle, like when your healthcare needs start to skyrocket on you. And, if you don't really plan for it, you start to become, you're at the mercy of, maybe a Medicaid plan, maybe you're relying on your family, things like that. And so it's just so important, to have that difficult conversation with clients about the no-go year. How do you want those years to play out? Like, do you want to go to a care facility that's a little bit nicer than just, something that might be a state-funded type situation? Do you want to be a burden on your kids, or do you want to make sure that you're taken care of? And so I think it's so important to have that conversation about the no-go years with your clients and how to fund that. And then the big thing with this type of a model is we're doing it with no out-of-pocket premiums. How many times have you talked to a client, they purchased that sweetheart long-term care policy, right? Got it in my 50s, got it in my 40s. This is a great thing. It's going to cover everything. All of a sudden now they're up in their 60s and the premiums are getting to be a point of almost being impossible to pay for them, right? When you need the coverage the most, that's when you see things start to slide up. With this type of model, it's a single dump in, put $100,000 in, like say, get the $300,000 in coverage. You don't have to worry about the cost of it going up as you get older and more into an age of where you're actually going to need that long-term care coverage. So just a little bit as far as how the product works. To access the benefits, you have to be unable to do one of 2 things. So the first would be being unable to perform 2 out of 6 activities of daily living, which we define as bathing, eating, transferring, toileting, conscience, or dressing. Or the second would be a situation in which there's a severe cognitive impairment that will then trigger your benefits to start being paid out. As far as what do we cover, we will cover up to 100% of home health care, hospice services, maintenance, personal care services, respite care, Alzheimer's, assisted living, nursing home care, and then we'll do up to 50% for adult daycare. As far as the elimination period, so we do have a 90-day elimination period. What's nice with this is if your client gets into a situation where they're unable to perform 2 out of the 6 ADLs, you can start your claim process at that point in time, and then we will work with you to help determine exactly when the 90 days is going to come up, and then we'll trigger the event. So that way, It's not like you have to wait for 90 days, then file the claim. Go ahead and file it when it gets started. We'll determine it. And that way, once we hit that 90th day, they'll start receiving the check. We are reimbursement with this. And then just so you know, we do cover the benefits paid out over a 6-year period. So the $300,000 would be paid out over a 6-year period. So they'd have up to $50,000 each year, in that type of situation. One of the things I think to me that really sticks out about the product and really kind of makes it an easier product to work with than some of the other options out there is the underwriting process. It is a very simple and straightforward process. So we don't order lab work, no medical exams, no substandard ratings. The way it works is you'll start out with your client, and we have this quick questionnaire. There's 7 questions. Client has to say no to all of the questions listed here. If they're able to do that, then they're going to move on to the tele-underwriting phase, and that's going to be a quick 20-minute phone call, mostly cognitive. If they can complete that, at the end of that phone conversation, you'll get an approval code, and you just put that on the application. And then from when you submit it, it really almost works more like an annuity application at that point than, a long-term care. We've had policies, cash with that policies that have actually issued out within 2 weeks from when we received the paperwork. If the client can't say no to everything, that's an automatic disqualifier for us at that point in time. The next big question that I get, how many times on the tele-underwriting or after the tele-underwriting is submitted and completed, can we still get a rejection? It can happen. The most common reason for why we get a rejection after they've gone through the tele-underwriting is because we find out they didn't answer these questions correctly, or they lied on the tele-underwriting process. But for the most part, I think we're at like an 85% issue rate once you get through the tele-underwriting. A big change that we made this year with the product because of the pandemic, we no longer require you to be with the client as you do the tele-underwriting part of it. So questions, and then you can have them call your client. They'll call you back as the agent and submit it, and then we don't require original paperwork for our we don't require original paperwork, so you could submit it electronically that way as well. As far as the minimums to get into it, for non-qualified, it's $36,500. We do accept qualified assets with this. So another thing that's really unique about this product compared to some of the others out there, you can put qualified assets into it. We have a maximum of $600,000, which we can go above that. We just need home office approval as to why, the client would need $1.8 million in long-term care coverage. Here are our current crediting rates. And so the way this works, sorry, I'm having trouble with my headphones. There we go. So we do have different crediting rates and terms. The most common one is the AnnuiCare 10. So we're using our Flex Plus 10 product, putting a long-term care rider on that. As far as these numbers, the 4, 5, 6, that doesn't relate to anything as far as the long-term care coverage. It's the same regardless of which version you use. These just refer to the actual surrender schedule on the annuity. So I know sometimes that trips people up a little bit. So I just kind of wanted to point that out real quick for everybody there. This slide here, probably one of my favorite ones in the presentation. So this is the fee for the rider for the AnnuiCare. And so as you can see at the top, this has been the rates that we've used since we created the product back in 1999. So our actuary team did a great job of pricing the product. We haven't had to go back and reprice it at all. So that's been huge for us there. So what we're saying here is if the client's age 65 and they get into a policy, their rider charge is going to be 95 basis points. And that 95 basis points is locked in for life. So the younger a client is when they get into it, the better it's going to be for them, just because we can keep that rider fee a little bit lower. So again, that doesn't change. So it's based on when they issue and when they get into the policy there. As far as state availability, we are approved in 31 states. One of our big projects for next year is going to be to where we get to where we're closer to being approved in like 45, 48 states. That's our goal there. So this is currently what we are approved and available in with AnnuiCare. As far as, where do we see sales opportunity with the product? There's a couple of different areas that we think people can really look for to really maximize and have the potential with the clients they're working with. One is clients that have old non-qualified annuities. We've seen this a lot where clients will have, let's say, an annuity is the current value is at $100,000, $50,000 of it, their cost base is $50,000 in gains. If you 1035 it in, they're able to avoid those taxable gains as long as it's paid out for a long-term care event, thanks to the Pension Protection Act. So any clients that have some old annuities, they don't need maybe the income that they initially maybe purchased, or just don't like the rates that they're getting on it. Great opportunity there. Because we take qualified assets, another big sales opportunity is those clients getting close to RMD age, and they don't have anything that they need to purchase. We hear this a lot, like, I'm turning 72, I don't need anything. I hate the fact that the government's making me take money out and I'm having to pay taxes on it. Could be a great opportunity to reposition some of those qualified assets into the AnnuiCare, get them that 3 times the coverage. The way it works with our product, if you do have qualified assets, the first 5 years of the policy, we're going to 1099 20% of the assets. So, you can have a situation where you move 100,000 in, 20,000 of it's going to get 1099. Depending on their overall situation, that might cover their RMDs. So, you could have a situation where the first 5 years, as we're moving the money from qualified to non-qualified, we're actually satisfying the RMDs within the contract. And again, they're retaining their full, the value there and getting that 3 times coverage for long-term care. And then the other one, and I think this is going to be a big one on the go forward. I think clients with, money, whether it be a bank, a savings account, we're seeing it. We definitely are feeling it where safe money rates, there's no return, right? With the 10-year treasury down around 60 basis points, clients might not really be impressed with what they can get in the bank CD or maybe even a MYGA type situation. And, with the pandemic, if there's a positive, is people are thinking about their health and their well-being. And so I do think there's a huge opportunity right now with this type of product to talk to your clients and just kind of say, hey, let's make sure you're protected, make sure we're going to get you the care and the coverage that you need. And, do you want 2.5%, less than 1% at the bank, or let's get you a 300% return, towards long-term care coverage. So another great opportunity there with that. That's AnnuiCare. Any questions I might ask real quick, Nick, if anyone has any questions on AnnuiCare before we shift gears?
No, not really. I think we're good on AnnuiCare. So no, just some other things with some volume, but I think you kind of got those issues taken care of on your side.
Yeah, sorry about that. My headset goes in and out. That's always an awesome thing. So apologize for that.
Wait, one quick question actually.
Yep.
RMDs on qualified money in AnnuiCare.
Yep.
How do you handle those? And you're normally going to have a distribution, so you're going to have that distribution period, so that'll take care of the RMDs because we're putting qualified assets, but we're liquidating that account over a period of time, so that should satisfy the RMDs. Yeah,
so it can cover all. I mean, it might cover a portion, if they're of RMD age. Just it depends on what the client situation is and what they have in total assets, that type of deal. But it can be a big thing to help move money over. I will say this product, I don't have any industry statistics. This one does seem to be one that gets used on older clients, as long as they're still in pretty good health. I think our average issue age is like closer to like 66 type range. So it can be a good fit in those types of situations to help cover. But then, yeah, after the 5 years of moving the money over, then it's a non-qualified contract at that point in time, which, again, another nice thing, if they don't ever need it, now it's more tax efficient to pass on to their beneficiaries. So maybe you should tell the kids about it, and their parents might move it over for them, and makes it better to move over to them if they don't need it.
Absolutely. Considering, and you know, you have to think about the current tax situation. So the Trump tax bill that we have in effect right now is expiring in 2025. So move those assets today before taxes raise, because I think if you took a survey of how many people think taxes are going to raise, I think we're going to be close to 100% as far as taxes in the future. So I tell a lot of my folks that, hey, you know, I think taxes are on sale now. So certainly may not be a bad idea to move over some of those qualified assets to non-qualified, as long as they're not opposed to paying those taxes now.
Yep, absolutely. So switching gears, WealthChoice, like I said, this is our first indexed annuity series that we launched. I really love the product because it's kind of a back to basics approach. It's keep the story simple. You know, I think when you look at the industry as a whole, we've taken a simple product and we found ways to really complicate it so that we have a story to go sell. And that's kind of when we get in trouble, right? Like that's when clients don't quite understand what they're purchasing, and all of a sudden that can come back and kind of bite us in the butt a little bit there. So WealthChoice, very straightforward, very easy to work with, and very competitive in certain areas. So it really stacks up. So I know there's a lot on this page. Just kind of pointing out, we do offer a 5, 7, and 10-year version of the product. The 7 and 10 year, you can add an income rider if you want to, and then it's just a single, joint, or trust owned for the contract, and we'll accept IRA, Roth IRA, or non-qualified assets. So can't do stretch, things like that in this one, unfortunately. As far as the base liquidity, what's nice, we allow a 10% penalty-free the first year of the contract. You know, most companies, you have to wait a year before you can access the funds if you need it. And then after that first year, it's going to be 10% of whatever your account balance is at that point in time. And then we do offer a built-in return of premium. This would come into play for your 7 and 10-year versions, where if the client wants to get out of the contract after the 5th year in the contract, so in the 6th year, they can get out, get their accumulation value, or get their initial premium back at that point in time if they want to. Again, that's built in. It's not like a rider option they have to select, and it's not something that we reduce down the caps if they want that option. It's just a standard feature for the 7 and 10-year version on the WealthChoice. And then on the 10-year, we do offer an optional premium bonus. So if you'd like, you can get a 5% bonus on the initial money in. There is a 5-year recapture schedule with that. What we do with this is we reduce down the caps and participation rates if they do elect to take this bonus rider, that 5% bonus. And I'll show you here. You can see on this page with our crediting rates where we are. So the 10-year no bonus is at 4.5%. If you want to take that 5% bonus, it goes down to 3.5%. We did just bump up our cap rate on the 7-year, so at 4.75. We're in the top 3 as far as caps tied to the S&P. So very competitive there from accumulation. And even at 4.5% on the 5-year, still a really good rate for clients that, you know, just don't want to tie up their money for a long period of time, just want to try to get a little better rate of return than what they might get with a MYGA or, a bank CD, the traditional safe money options there. As far as the income rider, it's available on the 7 and 10, again, completely optional. We'll issue the income rider up to age 75. One thing I'll point out is there is a 3-year wait before you can turn the income rider on. It's great. It's low cost at 75 basis points. So very low cost from that standpoint. And the way this rider works, and what's probably different about this than a lot of the products that are out there, we actually don't work with a benefit base or guaranteed roll-up rate. So what we do with the product is at the time they activate the income rider, we'll take whatever their accumulation value is. So in this example, 100,000 of accumulation value, they turn it on at age 75. That's a 7.5% payout factor. So in this scenario, they're going to receive $7,500 for life. We do increase the payout factors by 10 basis points in each year of deferral. the kind of simple way to remember what the payout factor is you just take their age and put a decimal point in the middle of it. So client 67, payout factor is going to be 6.7 if they take the level option. We do offer an increasing income option that grows at 3% guaranteed. But as you can see there, the initial payout factors are reduced down a little bit. So very straightforward from that standpoint. When I've worked with other companies, and even just for myself, when I was getting into the industry, one of the hardest things for me to get my brain wrapped around was the concept of a benefit base and how that's not actually a cash value. There's no walkaway value to it. It's, something that's used to calculate your income. And so I really feel like this is a very straightforward way to generate a guaranteed income stream. It's just a simpler story for the clients to understand. Hey, here's your payout factors, whatever the account is at that point in time. We multiply those two, and that's what you're going to receive for life guaranteed at that point in time. So really like that. I think sometimes too we get caught up too much in like what's roll-up rates, because it used to be back in the VA days, age 65, it was a 5% payout. And so really the differentiator was, well, what's it roll up at that point in time? Nowadays that's not such a key focus because everyone's using different payout factors. You can see here at 65, we're at 6.5%. And so there's kind of multiple ways to get to that high, strong income story. And we really focus on the payout factors, keeps the overall cost of the rider down because we don't have that benefit base growing at like a 10% simple and calculating the rider fee based off of that. So it does really well there. If nothing else, one thing to really remember, we don't reduce the payout factors for joint income. It's just going to be based on the youngest spouse's age. So as most carriers, you reduce it like 50 basis points or something along those lines. We actually still use the same payout factors. So if we had a couple and they're both age 65 when they turn the income rider on, they're still going to get that 6.5%, and that's going to go for both their lifetimes. So ultra competitive when you look at the joint income story with us there. One of the things that we found out is, when you look at income riders, when clients are actually utilizing them, it really is within the first 3 to 4 years of the contract. And as I mentioned earlier, we have a 3-year wait with the income rider. And so there is a bit of a workaround on how we can actually generate an income now. And it's not just that we are able to create an income, it's one of the best incomes you're going to find in the industry. And so what I did here is I have a little scenario where I'm using a WealthChoice 10 and I'm using the 5% bonus version. Client's age 65, has $100,000. I like to be very conservative. I don't want to show you guys something that back tested off the charts in this one particular situation, and that's what I'm going to go out and sell. I'd rather undersell and over deliver, with it. And so what I did here is put 100% in the fixed rate, which is currently at 1%, which is actually the guaranteed minimum on the contract. So that 1% rate won't go any lower than what it is. And what we'll do, because the client can take up to that 10% penalty-free withdrawals, we'll start to take out $5,950 the first 3 years. So we're just doing penalty-free withdrawals. And then in the 4th year, we'll activate the income rider. And as you can see here, they continue to receive that $5,950. Now it's guaranteed for life because of the income rider. So at 5.9% for a client that's age 65, one of the best withdrawal rates that you're going to get there. What really makes the story even stronger is if you think about a joint couple that's both age 65, again, these would still be the same numbers. We've run these numbers against SPIAs, and we've actually come out higher than SPIAs doing this income story. And I'll show you in a couple of slides where it stacks up as far as against other indexed annuities out there. Again, as I said, average duration is around 3 years to activate an income rider. 65% of income riders are activated within the first 4 years of the contract. But what do we always do when we ask for a quote from our IMO that we're working with? We say, hey, run it for 10 years, turn on the income at that point in time, and that's how we choose what the best product is. But the truth is less than 4% of policies with an income rider actually get turned on in that 10th year. And so really what we're just trying to say is when you look at our product and using this income now story, it's one of the best ones out there for as far as when clients are actually using their income. So I put together this grid. It's kind of busy. I'll walk you through it a little bit. So I'll pick the client age 60, 65, 70, and 75. And then we looked at taking income starting immediately, deferring for a year, starting income, deferring for 2 years, starting income. And then you can see here's our income numbers. And we did as far as how this stacks up against other indexed annuities in the industry. And then we did it for joint income, again, assuming they're both the same age, and where that stacks up to other indexed annuities. So you can see here across the board in these examples, for a single life, we're top 3 within those first few years. For joint, we're pretty much number 1 until you get out past year 5 or so. So where clients are using the income, that's where we're really strong at in those first few years of the policy. So a really good story there for us. We're pretty excited and really trying to promote that. I think when, we look at the industry as a whole, I know we've seen a big shift away from income riders with annuities, but I think given where, interest rates are at right now, and, with the Fed coming out last week and saying they're going to stay low probably for the next couple of years, I think people that are portfolio managers, it's going to be hard to get much return or positive return out of that conservative portion, and you're going to have to look for other sources of ways to help generate the income for your client. And I think this is a really strong story. I think it's going to make a really good comeback, and we really are kind of excited with what we have to offer in that space. Any questions on WealthChoice, Nick?
There was actually a separate question on the income, on no separate roll-up rate.
Yep.
So yeah, it's just the payout factor, not a roll-up rate.
Yeah, just the payout. Yeah, just the payout factor. So no roll-up rate. Again, I think that's a clean story to tell. It's just, hey, your account balance, and then the client has the chart of what the payout factors are based on their age. And that's what's going to generate that income. So it's, if you're deferring it out, you're in a strategy like the point-to-point cap. Like, we can't say exactly what the income's going to be, but we can kind of show, hey, look, worst case scenario, 0 returns. Here's what we can guarantee the value to be, and we can show, like, on our illustration software, here's back tested data. Here's where the number came out to be, and that kind of gives you that range of what it's going to be. So client says, hey, I got to have 5,000. Absolutely have to have 5,000. We're probably not strong in that position, but, most of the time it's, hey, I just need something around here. What can we do? And it's a lower cost way of generating that income. And then what's nice too, because I saw this, I used to work for Voya Financial Advisors, and so I was in the broker-dealer side. How many times have clients been sold an annuity with an income rider 10 years later, 15 years later, whatever it might have been? They don't need the income, but from a compliance standpoint, they're stuck because there's this huge benefit base, and an accumulation value that's significantly less. And from a compliance standpoint, they don't want to see you forfeit that, even if the client doesn't need the income. And so I think that's kind of the nice thing too with this product. By eliminating that benefit base, we're not trapping that client to, being forced to use the income rider. So situation changes, maybe they win the lottery between now and then type deal, don't need the income. They're still getting a really competitive rate to maximize their accumulation.
Absolutely. I think you guys are kind of, on the cutting edge of where we kind of see things going from an income standpoint, that those riders are evolving pretty rapidly among the industry, and a lot of carriers are kind of taking a look at that from a, these high fee or income riders to something that's a little bit different, kind of like what Guaranty Income Life has.
Awesome. And then the last one, best for last, right? Like I said, we are launching a new MYGA series that is going to replace our Guaranty Series. It's called Guaranty Rate Lock. That's going to go live on October 1st. And so with this one, we are, it's going to transition out. It's going to be a soft transition out. So there are a couple of states where the Guaranty Series is currently approved in. that we will leave it open until we can get the Guaranty Rate Lock approved in. And then we're hoping by the end of the year to be able to go ahead and turn off the Guaranty Series. What's nice, we are actually available in 41 states right now with the Guaranty Rate Lock. The current Guaranty Series is only available in 31 states, so we are actually opening up from that standpoint. And then we do have 4 states that are pending. The 2 big ones that really jump out is California and Florida. Just waiting on the state commissioners in those 2 states to get the product pushed through. But so we are pending, and so we're trying to be at 45 states here in the very near future. A big bonus on this one, we are offering higher commissions with this than what we did with the Guaranty Series, and still going to offer competitive rates for your clients from that standpoint. And again, one of the kind of unique niches of the Guaranty Series has always been the fact that we can issue up to age 100 with it, and that still will be the case for the 3, 4, and 5-year version of Guaranty Rate Lock. And then forced annuitization wouldn't be until age 110. So I never quite understood it when I started working for Guaranty a little over a year ago. Like, oh, Joe, when you talk about the Guaranty Series, make sure you say it issues up to age 100. And then now I get it. Like you get clients that have some old contracts and they're going to be forced to annuitize it. And this can kind of be that like rescue product to where they can transfer it over. You know, if they live to 110, then they're going to have to pay taxes at that point in time. But that kind of does buy some extra time. We do get a lot of business in that market of, you know, clients 90, 95 need to get out of what they're in currently. And so it can be a good home for them from there. What's nice with this new one, we will allow up to a 5% penalty-free withdrawal. The current Guarantee Series was interest only. So after the first year, they can get 5%. We do offer multiple levels of premium banding. So the more they invest, the better potential for return for them. And then again, it'll just be accumulation value will be the death benefit with that. What's a little bit different with this than some of the products out there is market value adjustment is going to be optional. If the contract has the MVA, we'll be able to give them a higher rate. A lot of times this is dictated more at the firm level than necessarily the client choosing, but that will be an option that is available. So that's why you'll see kind of 2 sets of rates based on if the client will take the MVA version or not. Kind of a lot going on here, but you can just kind of see we offer a 3 through 10 year. Again, the 3, 4, 5 issue up to age 100. Past the 5, 6 through 10 will be max issue age of 90. And then one thing that's different from the Guarantee Series is after you're out of the surrenders period, you'll have a 30-day window to where you're either going to want to move the money to a new policy. You can put it into a different term if you want to. Otherwise, if they do nothing, it's going to re-up into a new contract at that point in time, and it's going to be the same. So if I sold the 4-year version, after the 4 years, if I don't do anything with it, it's going to re-up for another 4-year period. So for those on the line that have used the Guarantee Series, just make sure you're aware of that little change. But again, that's kind of seems to be becoming more and more common in the industry as far as those windows to move the money out there. And as I said, again, 5% penalty free after that first year. Just have to have $250 minimum there. As far as the state approvals, so like I said, we're currently in 41 states. Florida and California are kind of the 2 big ones that we're trying to get pushed through, and hopefully by the end of the year. And then the Dakotas are the other, as far as it rounds out the 4 states that we're trying to get everything set up with. As I mentioned, there are 3 levels of premium banding. So the low band goes up to 100,000, medium from 100 to 250, and then the high band is going to be anything over the $250,000 there. And then you guys are the first to see the rates. You know, we're really trying to focus, kind of like we were with the Guarantee Series, really trying to be competitive in that 4-year space. It's just tough right now. I think our actuaries are either going bald or they're going gray. One of the two, you know, with where the interest rates are just as a whole, you know, having the 10-year treasury, you know, be sub 1% for, you know, 6 months now at this point in time. So it is where it is. We're going to be kind of in that top 5 in that 4-year space. And that's really probably what we're really focused on as far as, you know, our fit with this version, with this product. And you can see here, the top rates, this is the MVA version. If they don't want the MVA version, they will have reduced down rates from that standpoint. So just so you're aware of that. So that is the new Guaranty Rate Lock series. Again, like I said, launching on October 1st. So we are excited about where that product is at, and just kind of some of the more optionality that it has in our current one, and the availability as far as states go. So really trying to expand our footprint here with that one.
Yeah, absolutely. Joe, thanks so much. This has been a great webinar, talking about some of those unique products, especially, I know that one that elicits a lot of attention is always the AnnuiCare product. It's a unique product in the market, and especially as long-term care carriers have dwindled to a handful or less traditional long-term care carriers. So it makes the situation and looking at the AnnuiCare even more imperative than beforehand. So, of course, the guarantee for, going all the way up to age 100 is a cool concept too, because I think, you guys are the only ones, right, in the market that I know of that goes to age 100. So, yeah, but certainly, like I said, if you missed the beginning of this, we've had a long-standing relationship with Guaranty Income Life. Love working with the folks over there, and Joe and his team, and certainly, happy to answer any questions that you guys have. If you guys have some certain situations you're looking at, feel free to give our office a call here at Western Marketing. Our number is 800-852-7152. And just to recap from the beginning, this whole version was recorded. So we'll be sending out an email here this afternoon to all folks who registered for the event. There'll be a recap of the Guaranty Income Life, their products, the recording of the webinar, and as well as how to contract with Guaranty Income Life. As I said, it all goes to Insurance Bay, or online contracting platform. So looking forward to chatting with anybody with any additional questions. Like I said, one more time, 800-852-7152 is our number here at Western Marketing. Joe, thanks so much, and thank you, everybody, for taking time out of your schedules. We certainly appreciate it.
Thank you.